Hello everyone, my name is Michael Amat. I am the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And today we're going to discuss how much to buy. It's a common question. I hear it all the time. How many shares should I buy? And there's a couple of different ways that people like to buy, and the most common way is to take your portfolio and divide it into separate tranches. So let's say you have a $10,000 portfolio, just a nice simple round number to work with, and let's say you wanted 10 positions. So you would have each position be $1,000. Okay, great. So you would just buy $1,000 of this share, that share, that share, and that's it. You would call it a day. The problem that I ended up having with that idea was that you're not always risking the same amount per position. Let me explain. So sometimes when you're trading, and if you're doing technical analysis, you enter at point A and you want to exit at point B, it's not always going to be the same for every single stock. Sometimes you'll be able to exit at 4%, or sometimes you'll be able to exit at 7%. Your stop loss will be at different points depending on where or what the chart is doing. And so what I found was that I would end up risking different amounts on different trades, and the trades that should have more capital in them ended up having less, and vice versa. So to make sure that all my trades were risking the same amount, I ended up going with a risk-based position sizing strategy. And so let me show you what I'm using. Well, we actually developed a position size calculator, and we put it on ChartYourTrade to help with these calculations. It's relatively simple. I used to have this set up in Excel years ago, and a buddy of mine helped me develop this position size calculator. So we have it there. It's on the site. It's for free. So let's go check it out. So here we are on ChartYourTrade.com, and the position size calculator is right here at the top of the page. This works on mobile as well, so feel free to use it on your phone or on your tablet. It opens right up, and let's go through it. So to stick with our example from earlier, let's put $10,000 into the amount of capital that we have. And let's say that we want to just risk 1% of that capital. And let's say that we have a stock, and the stock is trading at $25 a share, right? $25 a share. Let's see what this gives us. Doing this on the fly. And let's say that we've identified our initial protective stop, that first place where we would exit if the trade turns out to be wrong, at $23. Right? Let's see how many shares we could buy. So based on that, we're able to buy 50 shares of this stock, and which is better than what we would have done before if we had just broken it out into 10 separate tranches of equal amounts and only bought $1,000 worth. Now we could buy $1,250 worth of this stock, and we're risking 8%. And we're still only risking $100. And that's the key factor, that we always want to be risking the same amount on every single trade. So let's say the protective stop wasn't at $23. Let's say that it was at $24. We could then buy 100 shares of this stock and still only risk that $100. And the reason why is because we're risking less on the position. We're only risking 4%, whereas at $23, we were risking 8%. So that's just a very simple way of how we're able to get the most bang for our buck and still risk the same amount per trade, and we could leverage our positions on the trades where our entry point and our exit point are closer together, and we could buy more of those shares, but we're still only risking the same amount. So if we determined on this particular trade that our target should be, let's say, $30, we're getting much better reward to risk if our exit point is at 23 versus being at 22 or 21, or it just improves. So it takes less to get to our target of typically 3R, or 3 times the amount that we've risked. So it's a lot easier to make 12%, let's say. So let's say we were using 24 as our exit, and this has to make sense on a chart in order to use it. We're not just picking this number out of a hat, or picking it because it looks good or gives us a nicer ratio to work with. But if on the chart it makes sense to exit at 24, then it's giving us a much better reward to risk ratio. It's a lot easier to hit a 12% gain on a stock than it is to hit a 24-25% gain. And so that's what really matters. It's the reward to risk ratio and being able to leverage a position in this way versus having an arbitrary 7 or 8% stop loss just somewhere on the chart that doesn't look at or consider where support is or where a moving average is or any of that. We want to be able to focus on stocks where support is close to our entry point, and we can leverage a position in this way. So come to the site. Again, the tool is free, and it works on desktop, obviously, and it also works on mobile. So I hope I was able to give you a little bit of insight into how I figure out how much to buy. If you have any questions at all, please leave them in the comment section below, and I will personally answer them for you. Thank you all so much for watching. Please like this video. Please make sure that you subscribe to our channel so that way you receive an alert every time that we post a new video. Thanks again for watching, and I'll see you again in the next video very, very soon.